Joining us now is Bank of America Chief Equity Technical Strategist Stephen Suttmeier. Well, really? I mean, because when I hear FOMO, I think danger, right? Maybe it's because I'm a parent, but is it enough room to run that one should really add to positions here or just not dump out of them?
I would say a little bit of both, actually. We are in one of the better seasonal parts of the year, June through August, where the market typically sees a summer rally. But I think what's even more important is we have cleared some important resistances on the S&P. First and foremost is the 4,200 level, which I think is a level that triggered FOMO to get the market to go to new 52-week highs beyond 43.28. So when we look at our technical price pattern on the S&P, we think that breakout above of 4,200 suggests that we can trade into the 4,500s on a summer rally here.
Now, are you just looking at the S&P? Because I'm a little concerned about the concentration of some of these mega caps, particularly the ones where people have been excited about AI and whatnot over the past few months. Should I be?
Well, I mean, look, there could be rotation in the market, correctly so. But what I think is going on here is that a lot of people are complaining about poor market breadth, but I would argue just the opposite. You're actually seeing improvement in market breadth. In fact, if you look at the S&P 500 advanced decline line, it went out at an all-time high earlier this week. So when the breadth line or participation in the market breaks out to a new all-time high, sometime in the future, the S&P can do the same. So I think breadth has improved. And it's not just the advanced decline line. If you look at 52-week highs, for instance, on the S&P, they're also expanding as the index has pushed towards and beyond that high from last August at 43.25.
So one of your colleagues at BofA, Michael Hartnett, put out a note and basically said he's not convinced that we're at the start of a brand new shiny bull market. Still feels more like a combo of 2000 or 2008, a big rally before a collapse. When you look at the technicals, are there certain charts or certain patterns that you see that remind you of previous periods as well?
Yes, actually, that's a great question, and I do think that this is actually not like 2008 and 2000. I think it's more like 2019, 2016, and 2012. Why do I say that? Because the market's climbing a wall of worry, that's why. And in 2019, we were worried about a trade war with China. In 2016, it was all about Brexit and the presidential election, and the market was able to rally in the face of all that uncertainty and fear. And finally, when we take a look at 2012, that was Eurozone debt crisis. I mean, that a serious economic issue, yet the S&P and U.S. equities were able to see beyond it and rally. So I think what keeps that technical pattern intact, just watch two moving averages. One's the 40-week and one's the 200-week moving average. The 40 weeks roughly around 4,000, and the 200 weeks roughly around 3,800. In 2008, for instance, and 2000, coming off those highs, those moving averages broke, and you didn't get beyond them for a couple years. Right now, we're sitting comfortably above both. So I would argue that it looks more like a trough in the market. And the bull market actually can date it all the way back to the October low. So it's not shiny and new. We've been in one for about 6 or 7 months already.
Okay. So the S&P closed above 4,400 again today, 4409. In terms of the actual levels that you're watching, what are they?
Sure. I mean, if you break out through a level such as 43.25 and 4,200, prior resistance often reverses roles and acts as a support. So if we did get a tactical pullback here, I would look for support in that range. Already mentioned the 40-week and 200-week moving averages, which are bigger picture levels. Mm-hmm. And on the top side, I would say we're paying attention to the 4,500 area. The cup and handle is the technical name of the pattern we broke out from. It's the pattern that the market was in from early February. That counts to about 4,580. So we're saying 4,500 is possible on a summer rally based on the breakout above 4,200.